Everybody. Um, we thought we'd get started a little early so we could go longer if we need to. Um, yeah, so what's on everybody's mind today? How's your trend following going? I have a couple of topics I'll throw out there if anybody's interested in discussing, or one is Moderna. Moderna's a crazy trade. I've been long Moderna. Totally luck that it's in my portfolio. But it's just a crazy trend. It's very volatile. And so it's one of those trades that is very unique in the sense that the volatility when I put the trade on at the breakout was very low. And so when it has these moves, plus $75, minus $75, it's one of like the biggest moves I've ever seen in a day. I mean, it would be a big move if it happened in a year, but I'm having like this 1 year move in a market that happens, multiple days. So this is kind of like, the upside or downside to not changing your position based upon increased volatility, that you have this tiger by the tail. And it's just kind of crazy how much it goes up and down and affects your portfolio. It's a massive profit, probably going to be a profit, obviously. But I don't know if anybody follows Moderna. And I think there's probably some other markets out there that have done similar things, maybe Tesla. The first Bitcoin trade years ago, that was probably one as well. And so my question is, like, how does my system handle these kind of trades? Am I happy with it? And once again, we're back to a situation where we have these issues. Like, I feel like I have an issue when I have a lot of profit. So kind of a good thing to be faced with, but I want to handle this trade correctly. When you make so much money, you've got this long-term trailing stop that's so far away. You haven't vol targeted. It's the same gigantic position that you had on when the ATR was really tiny. I think my initial ATR was 89 cents, and now the ATR, the way I calculated, is like $35. So is this like an obvious override? You must reduce your position. And so that's something kind of interesting. Um, and someone was quoting me, I think from a podcast where I think I must have said, love your rules, but not your positions. And so I think it's pretty obvious what I meant by that. You got to follow those rules and not fall in love with your positions. And I have done that over time, fallen in love with my positions and not really wanted to follow the rules because I just felt like this market was still going to have to, keep going up. So that's a big no-no. You don't want to fall in love with your positions, have them become your little friend, dispassionate, and follow those rules. So anyways, I'll open it up to anybody who wants to come up. And so much more we can talk about. Obviously, have lots of questions for Richard to explain to me all these amazing tweets that he has, but we seldom have enough time to get to all of them. So if you want to come up and talk, and just raise your hand.
Hi to everyone. As always, very happy to be here. Now I'm in very beautiful forest in the north of Russia, near St. Petersburg, and I'm very happy to be here and in this very beautiful place to take part in our meeting.
Hi Jerry, hi everyone. Just like Oleg said, pretty happy to be here too. My surroundings, I believe, are not as beautiful as Oleg's. I'm in the middle of the city, but that's fine. Regarding this changing ATR, I'm not sure how it was in the past. My experience with trend following is much shorter than you guys. I'm mostly learning here, but I tend to believe, mostly from what I learned from you guys, that it's just a matter of fact. It's the way that our systems are built. So not sure we should reduce our positions when we see this massive moves up. But that's definitely a reason for anxiety. Just tend to believe that we should enlarge the time span of our charts, take a look, see if this move is that big compared to history. I don't know.
I liked the phrase of Jerry in one of the systematic investor shows, and he said that I think that it's important to have systematic approach that doesn't require you to scale down often. I mentioned that reducing risk in drawdowns don't work in a good way. Probably better to reduce your position size when you make a lot of money.
Hi everyone, great to be here. Look, in relation to what Bruno was saying, I tend to agree strongly with him in that I personally feel that the whole reason we get our edge out of trend following is due to the non-linearity of the positions that we capture uh, with our outliers. So we can never predict in advance how big these outliers are going to be. And it's particularly this non-linearity effect which catches the human brain totally unawares, because it's only in hindsight we can look back and say, gosh, I wish I'd let that trade run further and hadn't reduced its position, or take some profits off the table, because at the time I was making that decision, it had moved 1/10 of the total move that it had done looking back in hindsight. And that's this non-linearity. It's this unlimited profit potential of any possible trade. We cannot, I personally believe, we cannot compromise that ability, because over the last 20 or 30 years, we might have seen only very moderate moves in the market. It's certainly different to, when we go back to 1925 and 1930 to 40s, where we see that the Dow Jones drops 95%. If, for instance, we assume that there is a particular level of which we regard as extreme, that's sort of contravening our whole approach for how we let profits run. So I'm a firm believer in just not tampering with the things, even though there's angst created by looking at your profit. Well, if that's the case, don't look at your profit. Just let it run. Let your systems, in their automated way, do what they're meant to do, and just do not tamper with them.
Yes, don't look at the profits. And it's kind of like this would be a great trade. It's kind of like I mean, I've traditionally looked at it in two different ways. It's a great trade. It's been in a trend for a long time. Let's say a year or whatever. So that's good. My average holding period is a year, but it can go longer, like 2 years, 3 years. In these long-term trends. So if you looked at the chart, it's a really nice trade. It's a good trade. It's a trending trade. But then it gets sort of supercharged by this sort of maybe random ATR at entry. Like it's 89 cents, and I only use that to normalize my losses. I'm going to take a multiple of that 89 cents. And if it goes against me, 4, 5, or 6 of those, I'm going to go flat just to treat every trade the same and to take the same dollar loss. But it's sort of irrelevant. Oh, but now it is like one of the huge reasons it's become a mega trade. It's a great trend, granted, but if the ATR would have been $20 or $5, it would still be a great trend. But now the ATR, this gigantic position that's become gigantic, and using the 89 cents had nothing to do with predicting or anticipating how great it was going to be. It was the opposite. It was, how are you going to handle all your losses? Well, I'm going to handle them all the same. I'm going to use the ATR, get out at 5 ATRs against me, and take a 25 basis point loss. So it's kind of funny how the trend and the mega trends can sometimes have feels like two components going on: trend and the accident of what was the ATR at entry. I know it's not really an accident, but it kind of feels like it. And this is why it's so important, as we've said, or I've said over the weeks, is be careful including these mega profits into your trade level, you know, because it's going crazy and it can be up one day. I jinxed it. I was like, I made 88 ATRs today, 80 in one day. Well, then the next day I lost 75 or 25 and then 75 the next day. So it's just kind of crazy. And it also calls into question, like, what is this research telling me? If the possibility of an outlier can be redefined so frequently, then looking at the outliers historically, they may be too small, and so you can't really take that from the research, because what can happen in the future could be something we've never seen before.
I totally agree with this, and I think we never know. One of the guests of Systematic Investor Show said, I don't remember exactly who he was, maybe Mark Jabrzynski, and he said that we never know how long will trend be. And I think it's very important to understand this and not to do something like wall targeting, and to be fully rules based, and the philosophy of trend following must be kept, I think.
I liken it very much to going to the casino. Provided we're always making sure that our realized balance is being managed and our capital is being protected, then whatever's happening in the unrealized world is basically our bet that, that's our pot of gold that potentially could, be our secret to success. So, yeah, just focus on realized balance and just don't focus on your unrealized profits and let your systems do their work.
Maybe I'm a bit of a heretic, or because I, manage family money rather than other people's. But when you get something that goes parabolic, and I had asked this on one of the Top Trader shows, and I think it was kind of agreed upon, when things go parabolic, taking a little off is okay. What I do is I just continue to scale my entries out, and also utilize point and figure as a good basis for seeing where I'm out. And so where I'm going with this is maybe what you can do, Jerry, is if you entered back when Moderna was $18 on the 100-day breakout, you could scale out according to each of your trailing entries, whether it's kind of like the 40 in, 20 out, or the 3.5 ATR based upon your look back period trailing stop, or something, so that you still have the bulk of the trade on, but that you've captured that profit when you have something that is completely asymmetrical. And I'll kind of leave it at that. But I certainly don't think there's anything wrong so long as the majority of the profit's on. And that's just for me, and I don't have to worry about investor money. And I know it's a different mindset. So at the risk of being labeled a heretic, I would take a little off. And the way that I do equities is, as the box sizes change, I continue to for point and figure, I continue to peel out at what I entered in. So when I get a new signal and I go long on a larger box size, that's my stop for that portion. And the box size that I entered on, say at $2 for Moderna, that's a separate exit than the bulk of the trade. I don't know if I'm explaining it adequately, but I don't think there's anything wrong with it, especially when you have something that is so out of the norm.
I think it all, in the end, we're all worried about our profits and losses, and what we take back to our clients or family or ourselves or whatever. I I don't think you should put in these terms, Brian. If you're a heretic or whatever, but if you're playing this role, I'll play the role of the preacher here, and I would say, what is the
Get in,
system
Bruno.
that what is the system that exits on this level? How profitable is this system? Sure, on one trade or the other, maybe it makes sense. Maybe we have this need to cut our profit. Maybe we have this time we have to do different. But what do this system looks like? Do we want to have this system on our portfolio? I don't think so. I'll try to take take your words back to you, Jerry. Keep your rules simple. Try to find the most simple system that's not simplistic, but it's simple enough to be profitable, to be um, predictably profitable. What's the simple size of this system that exits when ATR goes to the moon? What's the sample size of this system that enters on ATR's level, say 1, and then when it reaches 10, you exit? Okay, preacher's done.
I'll tell you something I do. If, for instance, I believe that my profit's getting extreme, and I have my charts on the daily time frame, what I'll then do is I'll click onto the weekly time frame, and then suddenly that extremity seems pretty normal in the weekly time frame. It's one of these, fairly big bars on the weekly time frame. And if that's too big, then I go to the monthly time frame and I see the past history over 50 years, 60 years, and I see that, well, these particular profits I'm writing aren't unusual in the scheme of the monthly time frame. It might be a large bar on the monthly time frame. So even if they go exponential, they can still go higher. I see where you're coming from, Brian, but I think that any form of modification that we do to our classic trend following system basically dilutes the net wealth at the end of the return series. Yes, it makes the equity curve more stable, but that sort of defeats the purpose of what we're trying to achieve with our net wealth statement. It sort of turns us more into, something that's appealing to an investor. And as you say, when you're dealing with your family's money, obviously you've got them to consider. And if they're looking at those profits, they'll be screaming at you to take them. So it's very difficult when you're managing other people's money. And that's why in my world where I'm doing it myself, it makes it a lot easier for me to grit my teeth, flip to the weekly, flip to the monthly time frame, relax myself, and then just get away from the charts and let the system do what it does.
I think managing one's family's money and client money, you're facing much the same difficulty in your, mini-max regret, minimizing max regret. I think rather than taking profits in a system that's supposed to offer convex returns, you reduce that beautiful convexity, that smile and the return distribution when you start taking profits. So, you just maybe buy a value strategy or something else alongside the CPA strategy to appease the other investors. That's my 2 cents. Don't dilute your trends.
Managing other people's money cannot be very easy because of psychological reasons, and because I think that investors' psychology, their mentality, mindset is something that is similar to mindset of young traders, because they don't know the structure of the market. They don't know the structure of a trend following system. And so, like Neil said, a lot of times we must educate educate and educate them. We must, we also here have, and Bruno said about this in a recent episode of Clubhouse session, we must educate our investors, and I think it's the only way. They must understand clearly understand how the system works. So we must show them the charts, show the track record, and so on and so forth. And I think it's the only way.
So I'm thinking this is another good reason to trade as many markets as possible, because it's not going to move my portfolio 5 or 10% a day, but it is one of over 100 positions that I have on, and it's moving it, but it's not something that's going to like scare people too much. And I thought it was pretty interesting that family money came up. Like, I trade my family's money, but I don't listen to my family, and they're all a lot poorer than me, so they kind of just probably don't think that they would have any standing to complain about anything. But and then I think another thing that that Brian said was out of the norm, out of the norm. And so I'm like, well, wait a second, that's what we do. We're waiting for the 5 or 10% of the trades that are out of the norm, but this is kind of like way out of the norm, I guess. So, but I think if I had an exit strategy, one of the things that I would not do would be, I would refuse, honestly, I would absolutely refuse to give all of the profit back. Absolutely refuse. And I would have a rule that prevented that from happening. And with a long term, I mean, my systems are pretty long term. And so maybe not on this trade, but it's absolutely possible for me to have a trade like this and the trailing stop not move up to where I could actually lose all of the profit. So I would not allow that to occur, but I would not do a counter trend trade either. So I would have a rule that was had no sample size, because I'm making a special rule for these crazy outlier trades. So it's just a rule, but it's not very good math. And I would make sure that it was a very painful give back. I mean, very painful. And so I'm doing a trend trade, and I'm just not going to give back all that profit. Maybe I'll have on of my 4 systems, I'll have 1 or 2 of them that will get back all the profit. Yeah, okay. So they will. But I'll at least have 2 or 3 systems that has this rule that is not a great, its only thing going forward is that it's a rule, but it has nothing else as far as back tests going. But it is going to be painful. It is going to be a massive retracement of the trend. It's just going to be something that I'm not going to walk out of Moderna with no profit. And so that's me being a heretic, maybe, because we got to make money. And the best way to make money is to trade these long-term systems. And that's going to be your big regret. That is your problem. You'll make less money. You'll make less money overriding and defining, this is a big trend. This is parabolic. This is out of control. So exit. That's fine. It's what we can all do. We have our own ways of doing it, but you'll make less money. It's not a system trade. You're overriding the system. And the back test will show you that if you trade these parameters, you'll make the most amount of money. So you're just saying, I understand that, but today I'm very concerned, and I know that if I do this over my whole lifetime, I will make less money, but I cannot stop myself. And so that's just the realization we all have to come to, that when you're doing non-system trades, you're going to more than likely make less money unless you get very lucky. But if we all did them, we would all as a group definitely make less money. Another thing I think is kind of interesting is that no one does this. No one sits with these trades who has a lot of money under management. Okay. I mean, I don't really know if no one does it, but I doubt if anyone does it. The large CTAs, they stopped doing this, when they started raising lots of money. And it's this constant vol targeting that prevents these large outliers, that reduces the skew in the non-normal distribution, and they sell it as this is a better approach, a more scientific and mathematical approach, because we're solving for Sharpe. And I think some clients, since they don't experience this traditional trend following, they have nothing to complain about usually. But I wonder if some of this sort of lottery type approach that says, hey, we could hit a Moderna, we could hit a Tesla, something that could go hundreds and hundreds and 1,000 ATRs. And I think maybe some of the clients would say, darn, then I can't get out. I've got to keep my investment there. You never know when we might hit a big one. And this guy is going to hang in there with it. So I just wonder if all of the advancement of CTA trend following that the larger firms have brought, I don't think they're much of an advancement at all. It's just not real classic trend following, and it's getting rid of some of the most important parts of trend following. And they've just claimed that clients probably prefer this, but they don't know. Maybe there's people out there who would say, I'm afraid to redeem. We could hit one of these big ones anytime. Very few firms give clients that opportunity to say that they even dislike holding on to something like Moderna.
Well,
I think, I'm sorry, I think that clients prefer money, and have said that before, that clients prefer maybe money every day, every hour, every minute, and they will be very glad if they found such a trader. So I think that we must don't think about client's opinion. Yes, when we're in a drawdown, maybe 6, 7, 8 months drawdown, clients will say that a lot of clients, a lot of investors will say that we don't know how to trade well. Yes, but when we will have this much big outliers, that big movements, big trends, and we will have a lot of good friends in the investment space. And when it ends, the situation will be the same. They will say that, so we must make money, we must follow our rules. And if we consistently make money for a few years, maybe 3, 4, 5 years of investment horizon, clients will like it, and they will like you in a period when you are in profit, and they will not like you when you have a period when you're in a drawdown. But it's not we must not think about this. We must be focused on our trading, on the following our rules. Only under these circumstances, only with this mindset, we will win in this.
well, just to kind of, I use point and figure, which is different than what a lot of folks use. But to kind of underscore what Jerry's talking about, in February of 20, so February 27th, the box size was 50 cents. And then it transitioned to $1. And then again in September, it went from $1 to $2. And in May of 21, it went from $2 to $5, stopped out at $3.90 and is waiting for a new sell signal. But we were literally 10 points away from transitioning from $5 boxes to $10 boxes. And it's still in a stable uptrend, and has been again since almost February. It had some chop in the spring of 21. So I mean, this is, as Jerry was saying, this is an extreme outlier. And I feel for you folks that have to capture, and I certainly, again, I use the system that I use, but I know I'm an aberration and a bit of a heretic, but 390 was the stop for Moderna for me. and I'll wait for the sell signal. And if it triggers at 510, then I'm going to $10 boxes and I'm in at 510. So anyway, I'll shut up and go from there, but I appreciate all of the insight, and I hope you do the right thing, Jerry, whatever that is.
But isn't the problem the same as always? There's some signals that are meant to be followed. You don't know if the signals themselves have informative value over and above whether to be long or short. In other words, there's no such thing as a signal that is a little bit strong, very strong, super strong. So, it's kind of difficult to say that everything is an aberration, whilst, as Jerry said, you're really staking money on the fact that, your entrance is your best trades are those where you enter and the ATR massively expands. So the whole thing is difficult to reconcile from a let's call it philosophical or abstract point of view, and verbalize, let alone put it into rules. So the whole thing seems to be a problem that is difficult to solve, rather than anything else, or aberrations or people not following rules.
Yes, I agree with you, Bruno. We talk about this aberration, about these outliers, but when I look at my research and I look at what happened pre-2000 for the prior 50 years for the S&P 500, I see that this period of mean reversion that we've had, particularly since 2002, even with the tech bubble collapse, we started to see quantitative easing coming into the market. We started to see the volatility of the market being suppressed by central bank intervention, and possibly also the increased participation of different forms of traders such as HFT, which came in sort of around 2008 in earnest. And over the course of the years, there's been this increased participation of different styles of behaviour with this quantitative easing. So I believe that period that we've experienced since 2002 up to now is effectively the aberration. So I believe that there's this market's desire to want to transition, but it's being prevented from transitioning because of the intervention practices or the types of behaviour. So what is the possible extent of a price move? Well, it's everything effectively from zero up to infinity as far as I'm concerned, but we've even seen zero being tested when crude oil went to negatives. But there's this lower bound and then this undefined upper bound, and I think the only reason that we get uncomfortable when we get these super profits is that we've been conditioned to feel that what has happened in the last 20 years is normal, is not the aberration. But if it is the aberration, then we're going to be cutting our feet off when markets do suddenly become very erratic. And this volatility expansion that we see that Brian was mentioning is a natural thing. We're trying to go for this non-linearity in the data. So we're trying to avoid the everyday market moves, the one up, the one down, the one up, the one down. As soon as it goes 3 up, 6 up, 9 up, that's non-linearity coming in. And personally, that is, I believe, where all of our edge comes from.
Hi, Richard. You bring up a pretty interesting point. I think I'm a bit of a smaller time frame than most of you up here. I'm more of a weekly trend capture, if you will. And I've been kind of caught in the one up, one down issue right now, where my entries are giving me false signals that I haven't really seen before. I've only been trend following for about a year now. And I've realized I've been in an environment where, maybe the dollar has only been depreciating, stocks only go up, and I recognize that that's kind of a time where, you might want to begin to get concerned, when everyone's thinking things only go one direction. So I kind of had a question for the room, which is, when your entries are giving you a signal, and maybe you enter, and you notice you're getting stopped out and kind of chopped around your entry, how do you manage that? And when do you decide to step aside and wait for larger price action?
I believe that's a symptom of your short lookbacks. If you enlarge them, the one up, one down will matter less. And that's and there's another crucial point that Jerry mentions all the time. That's reduce your position size per trade, so that one up, one down will not bother you that much.
I want to say a very important thing that if you trade less big periods of time frame, if you in the short-term space, your trend following must be much less. So if you trade 1%, your risk is 1% in a long-term space. Your risk in short-term space maybe must be 20 basic points, not more than that. Maybe 10 basic points, because there is a very big difference to lose your money or to lose 1% in a week, average losing period maybe a week, maybe, and to lose 1% few times a day. So if you trade 1% on our time frame, on very small time frame, it's a very risky to trade 1%. I saw on the site of one company, British London hedge fund, they said that it's very good golden rule of being 1% rule risk management based. Yes, but we must think about the time frame we trade. So if you are in a short-term space, your risk must be much smaller.
I think the short-term trading stops, the 25-day low or the 50-day moving average, those work really well when you have a big profit, and you feel a lot better. But they can really chop you around. And when when I bring up the weekly charts just to peruse, I'll see these massive trends that last for years. And okay, so the give back is healthy, but you do the back test and the computer says, yeah, these longer term systems, they make more money. You don't get chopped around. And so, yeah, if you're getting chopped around and whipsawed in and out, you're probably trading too short term, either your trailing stop or your stop loss, one or two ATRs. I used to do two ATRs, of course. And when I did the back test, the back test showed, no, that's way too short term. You make more money if you use something longer term than two ATRs. So it was all, for me, it was all about making more money. And then the less stress of doing so many trades, getting so pushed around by the market. And then you got to get back in at the highs. Now the ATR is higher, so your position's going to be smaller. And these long-term systems, they have a lot going for them psychologically and performance-wise. And then you convince yourself that you shouldn't worry too much about the drawdown from profits and big profits, and you're not subject to Sharp. And then you're like, oh wow, this is like totally stress-free. No one agrees with me, but at least personally, I can see that this is just a great way to trade, and longer term just creates so much less stress and commissions and slippage. It's yeah, I hate the short term stuff. When I switched from short term to long term in the late '90s, our long term systems had performed better in the '80s and '90s than the short term systems. So my first 5 years of trading, I didn't really have a lot of access to what the back test really said. I just had to go off of what I was being instructed to do. So the back test is an eye opener, and we usually give you the thumbs up for trading longer term. It's just that when you start trading longer term, you're telling yourself, oh, I'm giving back too much profit. I have too much volatility. So that's something you have to overcome?
I want to say that I was short-term trader for a few years, and I think it's a very good training for a person. And when you trade in a short-term space, you're always doing something. But as Neil said, as I remember, that doing nothing is also doing something. And so we're also doing something, but we must remember that we are not construction workers on construction on buildings. We are traders, we are investors, and here we face another rules. So I think we must follow them. And of course, it's statistically, if you are a long-term trader, if you have a courage to be a long-term trader, it's a really better decision in all, I think, ways, and even in attracting investors and raising money. Often I have heard that it's better to raise money in the short-term space. Yes, I agree with it partly, but in fact, as I said today, if you trade maybe 4 or 5 years, the result will be better if you are a long-term trader. And in the aspect of raising money, I think it will be also better, because the person who trade 4 or 5 years in a short-term space, yes, he will raise money, but I think it's a very big probability that he will be in a losing period, very big losing trades, a lot of losing trades, and of course investors will take money.
Hello, thanks for inviting me. I just want to know, just in the ballpark, what you guys think it's short term, medium, and long term, just to be sure.
I would, in my
Thanks.
models, I sort of span from anything from 100-day look back. For my breakout models, might be a 50 period moving average crossover for some of the other trend following models, and then it would span right out to 1,000 bar look back. I see the short term space. I still see outliers in that data, but I see them being destructively interfered with by noise and mean reversion. So their nature is a lot less of a cleaner signal than what you get as you start stepping out into the longer term lookbacks. And engineers find this problem, and they, in dealing with how to reduce noise. And what they do is they superimpose noise, a signal with a noise. They'll superimpose another signal with a different form of noise, and they'll continue to do that. And this is what you find in these noise cancelling headphones. The noise destructively interferes with itself and dissipates away, and the signal gets clearer. That's their way of making, reducing the noise in the signal. Our way of reducing the noise in the signal is by using longer lookbacks, because more and more participants, as you step up the time frames, they become the gross price action becomes clearer in signal than the subsequent noise in that lower time frame.
I love this idea of 1,000-day look back. That's pretty funny. I haven't looked at that honestly, but I wouldn't trade anything shorter term than 100-day breakouts. I don't trade those, but I wouldn't do it anything shorter than that. But I think, okay, so I've advocated that take a look at some of the largest trends on ever, and how did your system perform? This is just you looking at it and saying, okay, I got in here, I held it, and then had a big give back, let's say, Moderna or Tesla or the first Bitcoin. There's not a lot of them. You can just go through the charts and say, how am I performing? Am I making enough? Am I getting whipsawed in and out? The drawdown is a cost, as is the whipsaws. Then another thing to do is to look at charts that don't look like those. And a prime example would be wheat. Like I trade 5 different wheats, and I'm just obsessed with trading all of these markets. They're a bit different. They can be a bit different, but they are used wheat charts. Chicago, Kansas City, Minneapolis, and French. Then it's very choppy, and it would have these big rallies and crazy sell-offs, and then right back to the highs. And so months and months of this pattern, and it was lagging behind corn and beans and oil and meal and canola and rapeseed. And so you're just kind of like, what the hell is going on with this wheat? And then it would have these, the most choppiest. So my system just like never got out. And I think I don't start with a philosophy necessarily, but I think one of the things I've noticed about these long-term systems, or the way I like to implement them, is that they tend not to do anything if it's not material. Like, like I'm not going to sit there and do a bunch of trades when I'm losing, 4 or 5 ATRs and it's hardly having any impact. I'm not even going to do the trade. So, yep, okay, it was nice to have that wheat profit, and then it crashed, and it did that like 5 or 6 times over the past year, but none of those crashes were that material. And so, um, if I'm going to get uptight about anything, it's going to be when I have Moderna. Okay, now I have a big issue here. Am I going to trade it all with my systems, or am I going to make sure if I have to make that decision that I'm not going to give back all that profit? And that's exactly what I did in Bitcoin. That some of my exits never got hit, but I wasn't going to give back all that profit in Bitcoin, and it got to some points in that trade that it looked like that could absolutely happen. So that is not that is a little bit of heresy, but um, I definitely think that overlaying your system on some of these charts to see how you're handling tremendous choppiness or tremendous uh, upside parabolic profits is kind of a way for you to get a handle on some ideas that you may want to backtest. And obviously, I recommend coming to the conclusion that long term is going to make more money and cause less problems, a better lifestyle.
I think that I want to say that for me personally, if I would not see the backtest, did not see backtest, I mean, did not see backtest, didn't backtest, and did not know the opinion of Jerry, Moritz, and Niels, I would thought that short-term space is the same in performance, but like a long-term space, but it will be better because it's faster. And so only having a statistic, only knowing the opinion of the best expert can helped me to be a better trader and help me to begin trade in a from medium to long term, and I'm very thankful for that.
I appreciate your guys' comments, and I'm already, as we're speaking, kind of moving. I mainly use some moving averages and whatnot, and kind of moving through the time frames and trying to take a different approach. So I definitely it definitely appeals to me, the longer term. I just haven't necessarily dove through the strategy. So yeah, just want to say thank you very much, guys.
Yeah, I'd say general rule, long-term strategies trade each market about 1 to 2 times a year. Medium is probably double that, maybe, I don't know, maybe 2 to 6 or three to six, and then the short term is probably once a month or even more than that. Um, however, however you decide to define the trend and however you decide to get in and out, that's generally the frequency. That's I think, I don't know. That's kind of what I have in my head and what I've seen from doing all the tests over my 10 years. But anything that's like any system that's trading more than a handful of times a year is just the performance just goes downhill from what I've seen.
I think it's very good to trade from 100 breakout to 300 breakout signals with a time frame diversification.
Yeah, I'd like to shift gears here a bit. We're talking about longer and longer time frames, but how do you guys get the data for all these long time frames? Because we're mostly trading futures here, right? And it's I have some issues or some difficulties with getting this data. I know we can get them from the regular vendors we traders use, like, I don't know, Bloomberg or Reuters or whatever. I
CSI, baby. It's the best one.
Oh yeah, CSI. I've heard about them too. Never used it. Do you find them good, Michael?
Oh yeah. Yeah. They're very reliable, very accurate, and they have tons and tons of data. I believe it's pretty cheap.
Yeah,
Depending on the package that you want, how many markets you want, and how much data in terms of years you want. I think I spend between futures and stocks, and I have futures data that goes back to the 70s, maybe some that are even further back than that, including equities too. It's less than $1,000 a year. I think the futures package is probably around like $500.
that's good.
I also think that they have a very good product in the deceased companies, which I think it's a little more expensive, but at least it makes you have all the data, which is pretty important.
Yeah, there's other like CQG has data too. I think they're more expensive. Obviously, Bloomberg, you got to buy a terminal and very, very expensive. I'm not sure if they just offer data by itself. You may need to just buy the whole package. I'm not really sure, but
Yeah.
CSI I think is the best bang for your buck,
Okay.
and they
Yeah,
provide
I
everything.
would ask about buying the data from the exchanges themselves, but then I think it will get prohibitively expensive, right?
I believe so, and it's probably not very practical for you too, because a company like CSI and Bloomberg, they do that already. They're buying, they're subscribed to the exchanges, and they're just compiling and making sure it's all clean and all that stuff. So they're doing all the work for you. Um, you know, I don't even know what it would cost to go to like the CME and then go to ICE and then go to the New York Stock. I don't know. But I know it's probably a lot more logistically annoying to do all that rather than just go to one vendor, pay a little premium, and it's all done for you.
And Michael,
Uh,
when you use that data, did you use for backtesting purposes? I guess did you use the continuous contracts or did you use the single contracts? Because I used continuous, and that you have to decide how to make them continuous. I made them by myself, and
Hmm.
also when we are speaking about short-term and long-term type of systems, when you're using a long-term system, it's also not trivial the way that you change the contracts. Which way did you use?
Yeah,
We've done
they
both,
can't
but
be.
use primarily continuous. And look, continuous and just backtesting in general is, I believe, to give you an idea of how your strategy works. It's not meant to be some exact result to expect to the decimal place. What's going to happen in your own real life trading going forward for the rest of your life? It gives you an idea. It puts together again, like practically a what the markets would have looked like had you been trading them. And obviously in real time we trade the actual contracts, and then we are deciding on when to roll them and things like that are not replicable in a back test per se. We just know that, okay, buying the breakouts is generally a good idea. Selling, okay, generally a good idea. Okay, we're good. We don't need exact uh, uh, the exact results of
Yeah, that level
of the
of
back test
precision, right?
to actually play out in real time all the time. So that's why like continuous contracts are just kind of a general practical solution to test a system over very long periods of time. You can go with testing contracts, but you might have some problems with that in a long-term system because some of the contracts themselves don't have, let's say you're using breakouts of 200 days. The contracts themselves don't have 200 days of data. So then what do? So you're going to run into those issues that you're going to have to address, and you're likely going to address them by going with the continuous contract solution for testing purposes. So yeah, like bonds and some of the commodities, will run into those problems where it's it doesn't register a breakout channel price because it doesn't have enough data yet. So that's where testing that on long-term systems gets to be a challenge. For shorter term, you probably have more luck, but yeah.
I
Morning,
think
folks.
I think that the data is very important, of course, but it's never enough. It's never enough, and we must test as much as we can, as much as we have. And I think it's also very important to understand how your system works. So when we are talking about trend following, I understand that it's behavioral based system. So because of it, I love it so much because I understand maybe not all, not the 100% how it works, maybe no, but I understand that it's based on the structure of the market, and so I can be prepared for different events. And maybe Nils said, I think yes, Nils said that it's very important to the system to be organized in such way that it will be effective and will give good performance in the future, not only the past. And so there are a lot of artificial intelligent fonts. And as I remember, Neil said that if environment will change, this a lot of these fonts will blow up. And if we are trading in a trend following space, we will win. And so because it's adaptive. So I'm saying this because we of course we must treat very good the data, and we must do backtest as much as possible, but in some cases, in some systems like artificial intelligence, the past may look very good, but unknown future is unpredictable. So this all amount of data we have and will not help in this situation.
Hey, folks. I just wanted to jump in and say I've been using Norgate data. And it's good stuff. I think it's like if you just do futures, it's like $600 a year or something like that. It's not that expensive. The thing I'd say about them, I don't know what CSI offers, but Norgate has really good API. So if you're using anything in Python, if you're building your back tests or even just your signal generation in like a Python or Excel or an AMI broker or something like that, they have really good APIs or really good plugins that handle that. So I would say in terms of like those continuous futures, back testing is one thing. Again, I sort of agree with, I think it was Michael who was saying, it's more about just understanding, excuse me, the overall performance, but you're not going to get an exact back test of history. But when it comes to your signal generation day to day, I really highly recommend you build your own continuous contracts. You don't necessarily have to go back as far as when you're trying to do a test to understand the system. But if you look at the way a lot of these companies build their continuous contracts, they're really just gluing together the front months. And that doesn't necessarily make sense for something like, say, like euro dollar, where like the front month contract is barely moving at all. Whereas, I think I'm trading out on the 2023 contracts right now in my actual trading. So that's just something to be aware of. Is like the contracts that are put together in the continuous contracts are sometimes a little lazier in terms of their selection of what contract you would actually be trading in real time versus doing it yourself.
Yeah, that's correct. And if you have the luck to use the very expensive Bloomberg terminal, they have, I think, the best way to change the contracts. It's very easy to do, and they are one of the few guys who have the first notice, first delivery dates, etc. But I mean, it's very expensive. But maybe you have one at your disposal, and you can use that. That'd be great. But I agree with you that you won't ever use the chain contracts as they come in the API of any of the providers.
Also, I like doing my back test when I'm in a drawdown. So instead of doing something silly, instead of doing something that that is not in my rules, that will break the system, it's better to do the back test, to see the charts, like Jerry said, weekly chart, maybe monthly chart, to see that your system work in a long periods of history. So I like backtesting in this sense.
The other thing about stitched or pre-made continuous contracts is when other players are involved in the front month. So I can think of a good example is what happened last year to oil prices, where there was the infamous Chinese ETF or ETP product that drove the price because they made an operational error. So that this was the narrative. If you are using those kind of pre-made time series, you would see a negative oil price. If instead you thought about where you wanted to be in the curve for oil when you want to roll your futures and went out and built your own continuous contract, then this sort of disturbances would go away. And this actually is not just a data point; it sort of changes the result of your backtest because it's effectively using another data set altogether, even if it belongs to the same underlying issue.
I've never been too obsessed with the perfect data idea. I think continuous contracts are great. They're fine. And choose a rule and stick with it. The rule can have, Mike and I have done a lot of work on continuous contracts, and we've dug into them and seen insignificant parameter choices create massive differences. And so we kind of just write it off as, well, yeah, that's going to be pros and cons. There's going to be pros and cons on choosing the rule. I definitely think some of the markets, you have to choose different rules, obviously. And then if there's errors in the data, I think it could help you, it could hurt you. I have sort of written it off. I have spent money and time and energy cleaning up data, and I didn't see much benefit. What's the bottom line? Well, to me, it was, am I going to choose a different parameter? If I clean up the data and if I make sure I have perfect data, am I going to use, a different breakout parameter? I doubt it. So I didn't really think it was worth spending too much time on. We have a tendency to use closes only. I think the close may be more consistent across all the different sources, so it has to close above the highest high or close below the lowest low. And so we're eliminating open, high, low problems. Historically, I think that probably helps a bit. Definitely, you can't use percentages with the continuous contracts. You can't use any kind of percentage calculation. Yeah, so I think just be consistent. And if you really do want to dig into it, you probably want to realize that you need to total up the number of times that you've rolled and spread so you can calculate those costs of slippage and commissions. But yeah, so I think I haven't placed a lot of emphasis on that. It doesn't really seem to matter. I think there are some issues. I don't know if anybody has any experience with this, but I'm pretty sure there are issues with using traditional stock data that has splits and dividends included for trend following but I think there is issues with that. And then, of course, short-term interest rates. And there's a handful of other markets where we don't use a continuous contract at all as we're, creating our daily trades. So maybe we would use a continuous contract for some of those short-term rates. But once again, if we kind of foul up the short-term interest rate category, is that going to tilt our back test to say, oh, don't trade the 100-day breakout, trade the 120-day breakout? Probably not. So that's the whole point. We're going to do this back test over 30 or 40 years. We're going to get thousands of trades. It's kind of any sort of errors or luck and bad luck in our back test hopefully get kind of washed out. I'm sure that's not a really good quant way of looking at it. I did see this tweet the other day that's someone said their explanation to some sort of comment was that's the difference between quants and systematic traders. And I was like, whoa, I've never heard that before. I'm proud not to be a quant. I will, if I had to choose, I'll be a systematic trader. So I know that people
Be
with lots
nice,
of time on
Jerry.
their hands I'm sorry.
Be nice.
That's right. Be nice. No. I mean, I had always felt inferior to the quants, but I'll be happy to take the role as a systematic trader since we need those people as well.
Yeah, I love this quote. I've taken this to the heart too, and and I see a lot of quants around now and few systematic. And on this data issue, I think I've been more obsessed over this recently. I've tried data from Bloomberg and Reuters and CQG, and it drives me nuts that all these bars do not they're not the same throughout these vendors. I see different highs or different lows, different opens and closes are rare, just like Jerry said. But the bar changes, and that's why I'm getting this. I'm getting to this question to you guys. Sure, in the very long term, it should not really matter. It will be 1 day or two of different entry compared to the back test or whatever. And the final point is I do prefer to have rules in house about the roles and about the continuation of contracts. How do you make them the series continuous? But okay, I think I have enough information from you guys.
Just one thing, Bruno. You can go to Andreas Klenau's website. He's got a fairly detailed description of actually how you create continuous contracts, so that might be helpful.
Sorry, Richard. Could you say it again?
So Andreas Klenau on his website has got a couple of blog posts, quite detailed, which go into how you actually go through the steps of creating continuous contracts. So that might be helpful to you if you're looking for actually the mechanism of how to do it.
Oh yeah, great, thanks. I've tried to stitch the contracts one to the other in very different ways. To be honest, the so-called Panama roll has been enough for me. It's simple enough. It's consistent across time. It doesn't change too much the signals I see when I roll from one contract to the other. And then I'm not talking about just back testing, but about actual trading. When I take the percentage change from one contract to the other, sometimes it changes a few cents. The price triggers the signals, and when I do the so-called Panama roll, it doesn't. So that's why I'm using Panama now. But thanks, Richard.
No problem.
I kind of want to defend quants a bit. Sorry, I'm late. I missed the original question, but
Defend us, Derek.
Yeah.
Defend us.
No problem. I was just asking about data, as general as that.
Okay, but the data part, I totally understand. I think honestly, the reason why close is always the same, but the intraday is maybe not necessarily, is because some closing data is actually the settlement data, especially on futures, which is the fixed price by the exchange. But closing price, open price, high and low, and those things can be affected by time zone. So if you're like getting the data source from the local time zone of whatever exchange you're getting it from instead of just daily bars, you can build it up from 1 minute bars. I find that to be much more accurate, and then localize that time zone into either your local or to I just use GMT or UTC, whatever they call it these days. And then that builds you the most accurate bars. I also use the Panama method, and talking about Bloomberg specifically versus like say IB or CQG. If you use their continuous contracts, they're not super explicit on the rules on why they move it over. So like Bloomberg does have a PDF on how they do their role, but if you're building it yourself, I think the Panama method with your own filters. So I like to have like 3 consecutive days of increased open interest and increased volume in those contracts, so it's consistent across all of my different instruments to do that. And then you have a lot less problems because some of those might just be by date, and then actually people aren't rolling yet. So if you have like say crude oil versus something that's a quarterly, like say agriculture, then they actually might roll on a fixed date to expiry rather than when actually people are rolling. So that could be part of the reason you're seeing distortion. To defend the quants, I think there's many different types of quants, especially if you look at big banks structuring quants, pricing quants, and then what I would consider myself, although I'm probably on the lower end of things, is the alpha generating quants. And most of the time that you're the alpha generating quant, you end up being a systematic trader. It's just how you look at things because you've built this model. You are trying to understand the world through data, through your back tests, and it just gives you slightly more tools. But in the end, I think you do end up simplifying. And the thing I'm still struggling with these days is making it as simple as possible, but no simpler. I think that you have to get complicated before you can get simple. Maybe everyone kind of goes through that journey, or at least that was my journey. So then understanding what is the minimum amount of complexity I need to get, say, 80%, like 80-20 rule or something. I get 80% of the information with only 20% of the complexity is really where I'm trying to be.
I'd love to kind of take something Derek said there, talking about how the data might be depending on the time zones you're using to process, to ask a question about when people are doing their trades. So for me, I like to maybe keep it simple for myself, potentially at the expense of my system in some ways, in that I really check my system, 5 minutes a day, and do all my trades then at sort of the same time every day. But trading across markets that are in Europe and in Canada and the US and different time zones, that means I'm trading off hours sometimes. It means I'm not necessarily where the market is the most liquid. But I'm curious to know if other people are following the times of the exchanges. Are you trading at the open in London as well as in Chicago, as well as in New York? Or are you guys just kind of, some of you probably have your things completely automated to do that for you. But yeah, are people sort of trading one time a day, or are they trading along with the exchanges during their most liquid hours?
Well, I think we started trading. Well, okay. So once again, we use the closing prices. So we get a signal when the market closes, and so we kind of do the trade shortly thereafter, in the after session, after it's settled, or the next day when it opens, or that night. But we're kind of a hostage to these closes, and I think that has worked pretty well. And we did the back test close versus the highest high, the lowest low, or the highest close or the lowest close. So we did the back test, and it's the same, pretty much the same. I think you can have periods where not looking at the market throughout the day and selling the low and buying the high, you'll be very disappointed that you don't do that. Doing things on the open or on the close March of last year, February of last year. It's a lot of crap is happening. The world's coming to an end, and I'm waiting for the close. Holy smokes! So just throw that out there. And then, so that's what I've done. It's simple, and we have a lot of markets and a couple people doing the trades. So to keep their life from being totally chaotic, they can sort of concentrate on what's happening near the close or happening during the open. I would maybe have a rule as well that says, okay, when all hell breaks loose, let's go ahead and do a trade intraday. Just trust me, it's going to close below it's going to be a trade. We don't have to wait to the close, and we're getting crushed here in the whole sector. So I think I'll have an override for crazy times, a specific rule. But yeah, I think if you chose, theoretically, if you chose, I'm going to do all my trades at 11, I'm going to do all my trades at 12 or 2 or on the open, I think just being consistent, once again, is probably the way to do it. If you're going to choose a time of day to do the trade, that's probably more important than the exact time. And yeah, you did mention liquidity. I'm kind of small trader, so but yeah, liquidity is an issue, and the open tends to be the most liquid. I know that's not universally true, but usually the open is pretty darn liquid.
Yeah, I mean, I'm certainly far smaller than you are, Jerry. Yeah, the liquidity question for me is less about, can I actually put a trade of the size I need? I mean, I'm trading, very few contracts, a lot of the times just one or two, right? But it's more about whether the spreads are worse in the off hours versus during those more liquid times. But yeah, thank you for your call, or for your answer to that. Yeah, I think it's, there's certainly a few markets where I do have to trade not at my normal time just because they're not open. Some markets, especially in the agriculture sector, are just closed other than certain hours. But yeah.
Yeah, the reason I'm so obsessed about the bars, about the highs and lows, is because I extract my signals from the highest high breakout or lowest low breakouts. And I have automated my trades so that when that breakout is hit, my trade goes online. So I'm trading the whole day. And Derek, you said about you talked about the different closing times, but shouldn't this data be booked on the session date? I mean, I don't know. For example, crude oil opens the Monday session of crude oil opens in Sunday evening, and it goes all the way 23 hours until Monday evening. So that close, that the timestamp is for Monday, should be regarding the session that began all the way back Sunday, and that should be the same for the highs and lows, shouldn't it? I don't know about stocks, but that's how futures are traded, right?
Yes, but it has to do with the comparison of different data vendors and specifically the rolling aspect of that. Each individual day, if you're just looking at OHLC data, should be basically the same. And again, it has to go with, are you getting the actual close last price, or are you getting the settlement price as your close? Since you're taking intraday highs, that should be triggered, whatever your time zone is, regardless of daylight savings time or whatever, to your signal, like at the moment it happens, contemporaneously. Um, but I have found sometimes maybe you get bad ticks if you're recording your own data or something. There is a possibility that extreme highs and lows get busted. It doesn't happen that often, but it could happen during a crash where then that gets truncated off, but it actually existed. So if you were there, you would have taken the trade. Then at the end of the day, it gets busted and you have to go back. I don't think it's a really big issue, but there is a potential for the data to be dirty. So for me, I always like to understand uh, where things could go wrong.
and then understand to have my ability to clean the data and process the data in a consistent way um, across all the markets. Does that help?
Sure, always. Thanks.
Actually, Bruno, in my world, which is Forex and CFDs, we do have session times, common session times for Forex and CFD markets, which are based off the derivatives of futures. But we do, each broker, depending on where they're located around the world, have their local session times, and their bar data or their time series data is constructed based on their local open and their local close. So you've got a session time occurring somewhere within that bar, but dependent on the local time zone of the broker, the data that's created, or the bar data which we use for our testing purposes, etc., is basically in their time zone. That's why we've got to use either a GMT offset or a UTC offset to synchronize our data when we analyze between different brokers' data sets. I think Derek was referring to the UTC and GMT offset as well.
Oh, sure, I get it now.
Oh, sorry. I have a question about what Jerry said. And I don't know how many of the illiquid markets like OJ and lumber you're trading. Um, you are probably the biggest one out of all of us, but I do find that the spreads in those types of things can be pretty large, and doing it in the off session, or maybe I mean, lumber is just really the one session. How do you deal with that? I mean, for me, I'm mostly just trying to get filled on the limit order and know my price. Or do you just build it out throughout the day and try to get it done? Or how do you deal with those smaller liquidity markets?
Well, first of all, our main focus is to trade small, get a good fill, and so we will not be consistent always doing it on the open because that's not possible. And OJ, milk, lumber is a long list of rough rice. So yeah, we got to spread it out and do one lots and do algorithmic trading that's available, a simple algorithm, time volume weighted, time weighted, one lot limit orders, and we'll just take all day. Or if liquidity comes in, we'll take advantage of it if there's a big offer, possibly. And sometimes you can put a big bid out there yourself, and it won't spook the market, and people will just peck at it, and you'll get filled. But it was just hammered into my head from day one, to be very concerned about the fills and use limits. They're like a superpower. You just got to have patience and don't get frustrated if you have to move it up. But over time, it's like one of those life lessons. The market order feels better, and you'll never get too frustrated. You're just done. You're impatient, and you got to have it done. But it's just this silent killer that you're always getting a crappy fill. You're always paying up. Where the limit order is time consuming. You have to chase it sometimes. Every single time you chase it and you keep having to move your order up, you remember it. It bugs the crap out of you. So, but it's the far superior method to accept some of that pain every now and then and just be sort of as passive, putting these trades on as possible. Sometimes, these great breakouts, they're going to be messy. And then you're going to tell yourself, well, I'm going to hold it for a year or two, hopefully. Why am I so obsessed with getting this proper fill here and doing the best I can? But I still like to default to being very careful. And, so we do take our time. We always have. We've always traded. Sometimes we were the biggest trader in some of these markets. Cocoa, the infamous cocoa trade that. And we would just get in there and say, let's take a week, and hopefully we get a good average fill. And it usually worked out pretty well for us. One thing I wanted to mention was that I think Brian had a tweet this week about wheat. And that's another thing that happens too. You're trading these mini contracts, or you're trading a small market. Somebody puts a big order in. It creates this ridiculous low, and it pops right back up. It was a trade. It's not going to get busted. But the big wheat contract, it didn't have that low. But the mini wheat did have that low. What do you do? Like, I just don't think you obsess over stuff like that. You know, just create a rule. You know, I'm going to respect every bit of price action, then go with it. Or I'm not going to. I'm going to edit my data, and I'm going to use and I'm going to every day make sure if I have these big, crazy looking ticks. I'm going to edit it out. And so that, I think that could be okay as well. I just don't think it's worth, in the long run, getting too uptight about it.
But in my case, what I do is I use stop limit orders. That's because I trade through interactive brokers. So what I do is through the day, if I get the stop and it runs away, I just wait to if it becomes a limit again. And if it doesn't by the end of the day, then I trade at the price of the end of the day. Uh, but that's because the interactive brokers API and the system is very, very useful. The drawback is that they don't have enough markets to have lots and lots of contracts.
I think something that was mentioned, or maybe it's just a side topic I was thinking about, was this whole how long does it take to get filled? And I am firmly of what Jerry said. If it takes a week, it's okay. And I've done actually some studies on this. Basically, the alpha decay, or how much edge do you lose by how long it takes you to enter the market. So, like, you could imagine if you took your signal 1 day late, or 2 days late, or 3 hours late, or whatever. And for our type of, say, medium to long term trend following, you can wait a week and you will lose very little, maybe 5-6% of your quote, potential edge there of the net 100 that you would have had. So even though you are patient, you don't lose very much. But if you do go market, you're absolutely going to lose something. And I think that's the kind of interesting thing. But 100%, I have the issue of like, okay, got this limit order, we're chasing, or like, or you try to do the TWAP or something, and then it's like, well, it's taking forever. I don't know why that part of the psychology still bothers me, even though I've done it so many times.
That's right. It does bother us. Oh, and buying the high tick of the day. Oh my God, don't do that. Boy, you'll never go to sleep if you buy the high of the day, and it's immediately a loser. But these are just things that you need to overcome. I do think that I have seen, waiting can be very costly, especially in February of last year. But I have seen people who write a lot of papers do these back tests, and they'll just throw this feature in. This one group, I know they throw this feature in that's we hit the breakout, for instance, but we optimized it and it said wait 2 days. No, stop. I don't do things like that. And of course, they got crushed last year for waiting 2 days. But to me, it's even worse. If you have to take a week to do the trade because of liquidity, and it's a commodity that you really is going to improve your portfolio, that's execution. That's fine. But to make it a feature of your system, it's just totally going to be due to some sort of back testing over optimization that says, hey, we can pick up a few basis points if we wait 2.5 days before we do the trade. Oh, and maybe it has this other unfortunate psychological thing that they need, which would be, oh my God, I just can't handle buying another false breakout. I mean, you got to get over that, just do the trade, and you're not gambling with, don't wait. Sometimes these trends, I think a great system would be, I haven't done this, but I'm guessing that it might work pretty well. And that is, the more extreme the move in the direction of the trend, the quicker you should do the trade. That's right. If it's a new breakout that's just kind of wimpy, that's kind of probably not as good as it opened 2 ATRs through the breakout. And because human beings are going to sit there and say, wait a second, I don't want to buy that. It's too crazy. Let it back down a little bit and calm down. I think buying those big volatile multiple ATR breakouts above your level is so hard to do. It must be the right thing to do.
That's funny. I actually have a good example of that recently, which is the French wheat contract that broke out massive, and it was one where we had to chase, and it ended up being fine. It took us all day to try to get filled, but it ended up just running away with it. And I just want to be clear that the reason I did this study by lagging these things is not to wait for a confirmation, but to see like how much time I have to work with before I get a severe detriment to my fill or to my system, where it's like you're losing too much of your edge because it takes you too long to get filled.
Yeah,
Yeah, exactly.
agree with that, Derek. But one of the things is that when we're going for these outliers, there's such a material move that things such as transaction costs, a bit of slippage with your entry, a bit of slippage with your exit, um, they're really inconsequential to the overall magnitude of that outlier. So, if you're worried about that, it possibly means you're too short term in nature.
That's right. I mean, it's like you're risking 50 basis points and you're so uptight about it. Then you have a trade that made 300 ATRs and you're like, what was I even thinking? And it's the same thing, it's putting that trade on with that minimal slippage. And then you look back and you're like, these good trades, sometimes they're going to be hard to get on and it's going to be messy. And it's probably a good sign. I was taught that that's a good sign. Don't miss that trade. Don't wait for that pullback. Oh my gosh, pullbacks. Worst idea ever. But I can't tell you how many over the years I've met people and they're like, this is a new feature I have that I wait for it to pull back before I do it. The psychology is just all wrong. I love these breakouts, love the trend. More trend, the better. It doesn't necessarily mean it's going to be a better trade, but you're understanding that what you're asking yourself to do is something that's hard for people to embrace. So when you have these moments of difficulty, you really got to step up and be consistent.
These words are very important for all of us. And of course, I have said this many times that even in business in general, and maybe many fields in life in general, if you want to be a successful person, you must feel a comfort in uncomfort circumstances to most of the people. It's very important to understand.
When we talk about pullbacks or retracements, what we're effectively doing is volatility adjusting at the front end of the trade as opposed to the end of the trade. So what it's always predicated on is a predictive notion that a trend, a price will revert back before it heads back off in trend. And we find that that's often not the case. So you get that classic type 2 error and you totally miss that outlier. And then for the next 2 years, you're talking to your kids about the trend that got away.
I think we focus so much on the entry part. What about getting out, right? I mean, working your exit as well, the same thing, getting out. And I think that's maybe even more psychologically painful if you're giving that up. But I think the same psychology applies.
But just to be sure I've understand your point, Jerry. Say liquidity is not a problem. If a signal comes, you would trade it as fast as possible. Is that right?
That's right. That brings up another good point. So in the boons, I would do it instantly. And in OJ, I might have to take a few days. But your point was perfect, and that is as fast as possible, but without screwing yourself and moving the market around and ensuring that you're going to get a really bad fill every single time. One thing that we did was that we started coming up with new rules. Many years ago, we had new rules on execution. We were very large, and we basically said we need to have these um, different ways of executing and not throwing it all in there and not using limits all the time. And so we started measuring our slippage, and it was huge. And then we said, okay, um, we sort of proved through that process that the way to get the least amount of slippage was to do the trade as soon as the signal was hit, whether it's on the close or the open or whether it's intraday. And then our slippage went like almost down to zero. And so our rule was start immediately, but just don't go too fast to move the market. Use limits, and maybe mix it up, but just be determined to do it as fast as you could. And that was what we found. It's like, why did you have to go through all of that to figure out that the way to the best techniques were just to do the trade when when the signal was hit? It was like, we were getting dumb. The smarter we got, the more assets we had under management, we were getting dumber and dumber and trying to um, we would read articles about other traders who were analyzing the best way to execute. And we just said, stop this silliness and just do the trade like we'd always done it.
Yeah, I have a pretty small size here. Most of the markets I trade a couple of contracts. It's hardly more than 10 contracts per trade. And the way I automated this execution, it's similar, I think, to what Andres said. I have a bunch of stop market orders, and they move the market a bit, but the upside is that they are executed right away, as fast as the signal is hit. I'm thinking now if this is the best way to approach this. Perhaps when I grow larger, this will not be the case, but so far, I don't know. And I'm trying to gather data on my trades. I'm trying to accumulate a couple of them to calculate the slippage to have an answer for this question.
Yeah, I'm going to review that also because I think that maybe it's too complex. It's stop limit orders throughout the day until the session ends and then at the market. But in the beginning, when we started, we thought that we wouldn't want to chase the price too much on the intraday. That's why we use the limit. But maybe we will change it too because the least moving parts, the better.
I go 30 minutes after the open of my broker, and I go on market. So all of the algos just review 30 minutes after the open of the broker, and then they'll go market orders on the 30 minutes after open. So I'm like you. I like just getting in quick.
Yeah, for me, it's more limit orders, but then obviously if it's too big, try break it up. But in the sense of doing the limit order and then try the system basically, so the algorithm basically checking if the limit order is filled. If it's not, then it will check the new price and adjust the position size based on that. So it's almost just trying to get in. Um, Taking into account the obviously the slippage, but the main goal is to get in because of it being long term. In the end, I see it as beneficial in that.
Yeah, for the good ones, it doesn't really matter. You're going through the roof with a trend. You're earning a lot of ATRs worth of PNL. But the question is on those trades that fail, that 60% trades that fail, and the execution might kill you. Just like Jerry said, it's just feels like the silent killer.
Another thing that I do is I set up my slippage for my back test using a percentage of the ATR. So I just apply, I guess you could do it per market, but I kind of just tax every trade a bit for the percentage of the ATR. And then it really impacts your back test when you have something, think of what my slippage is going to be in Moderna, since the ATR of that has increased so much. that I'm really going to penalize that trade and getting out for that amount of slippage. So that's another thing that's kind of, I highly recommend that. And that's going to lead you to want to trade longer term as well, because getting in the trade at, a tenth of an ATR or a fifth of an ATR as your universal tax on slippage, when you exit that trade and the volatility has increased dramatically like that, it's going to be quite a hit to that P&L. I don't know how everyone else does it, but that's the way we've always done it.
If I do a Monte Carlo test on my trade distribution, what I'll do is I'll set a broad range for possible slippage, 4 times slippage, 2 times slippage, over across, 50 variables. Do the Monte Carlo, and you'll see that the materiality of the slippage, no matter what size it is, in respect to the overall equity curve, is incredibly marginal. We get a very tight band of Monte Carlo arrays of your trade distribution, which just demonstrates that you shouldn't worry about that small minor deviation at the entry or at the exit, because seriously, in the scheme of things, with the returns that we're getting, it's immaterial.
Yeah, and it gets more immaterial the less trades you make, right? If you're longer term, you're going to make less trades, you're going to suffer less from slippage and so on. I think this is
Absolutely.
crucial. This is really important.
Absolutely.
I want to add on to that a bit. If you have multiple systems, multiple time frames that you're trading, you're in effect splitting up your orders as well. That's I wouldn't call it a free lunch, but you're splitting up your market impact across however many time frames you're looking back, unless your breakout. I mean, they're all at like the highest high, but you will get a free benefit there of just following your rules and then dividing up your orders, which will cause you to have less slippage. How we measure our potential slippage in the back test is probably slightly more complicated than what's been proposed. We use a version of something called Kyle's Lambda. You can look it up. But basically, we look at the order book and its moves, and then we can estimate for every 10 contracts how much it moves the mid price, and then that's how we figure it out. But like everybody has said, if you're trading a longer term, what the proportion of your return that you're losing from these types of slippages versus the total trade return that you're going to get at the end. It's just tiny. So yeah, okay, you can save yourself a few basis points, and that can add up over the year if you're just doing conservative kind of things like limit orders and managing it and not trying to rush in and push the market and things like that. But there's probably better ways to spend your time.
Yeah, I think the main goal is catching the outliers, right? So, as you said, like, and as everybody mentioned, like, that's more important than, that little slippage in the beginning.
That's right. So I feel like that our club is so benefited from having, clients like Derek and Richard, who have embraced this type of trend following. And I think that is just the best thing ever. And then they're, able to explain some of these trend following concepts that, in a much deeper level than I've thought about in some of them. And I wanted to bring up a couple of topics that maybe Derek and Richard can address. Um, in whatever you want to talk about. But these are some things that you've mentioned on Twitter or in the Clubhouse that I really didn't completely feel like I understood. And that is, I've heard this a lot recently, even from Niels, and I haven't asked him, but it seems like everyone understands what momentum is versus trend following. I thought it was the same thing. Um, and I think Richard has mentioned another topic, which is don't think in terms of factors, think in terms of trend following or outliers. Wasn't sure exactly what that meant. I really like Richard, sort of coining this whole idea of we should call it outliers, hunting for outliers over trend following. I know that that's what I learned in 1983, and I kind of wasn't on top of that as much as I am now and should have been. So yeah, those three ideas, if you want to comment on those, momentum versus trend following and factor versus trend following or outliers.
Yeah, look, what I was meaning there was that when people, a lot of traders focus their attention on these isolated risk premia or factors like inflation or interest rates or individual focuses. What I'm saying is that outliers can be for a vast array of different reasons. It might be an exogenous event like a tsunami. It might be, a major technological development that outside of the finance world that suddenly flows through into the finance world. It might be a cat running across a Nick Leeson's keyboard as he's trading futures. It could be a vast array of different reasons. So you can't isolate outliers to a particular singular reason, and they are unpredictable in nature, and they catch people off guard, particularly because they come from left field. They're things that people never consider. So when talking about outliers, we benefit from these outliers. And I know people always talk about behavior, but actually the behavior is a secondary symptom associated with an outlier. Like when a tsunami occurs in Japan, suddenly the Nikkei gets hit. Now that's an associated behavior resulting from this event of the tsunami, which flows through into the markets. And you get this cascading of impacts which are totally unrelated possibly to the actual finance markets themselves that flow through into the finance markets. And then, of course, you can get endogenous events within the markets itself, so like the Swiss D-Peg in 2015. They're things that people that only considering a singular factor or a risk premium will totally be blindsided to. It's a bit like tribal council where they're sitting there very, very, sure that they're not going to get voted off, and then suddenly they're blindsided by something they never ever considered. That's what we're dealing with outliers.
I will try to add to that. I will do is my understanding, which is maybe a bit more academic. I hope to keep it short and sweet. The momentum factor was one of the original factors from Fama French, and it comes from the equities world, which doesn't really blend that well with what we do in CTAs. And it was originally designed as go long the equities that have the best returns over the past year, but measured in percentage terms, and short the ones that have gone, like say negative. And then you create this, like a delta neutral portfolio. If you look, that's the cross section. What we do is a time series. So we look at the individual market itself, and we take the trade or the trend in that individual market as opposed to relative. So that's like the first thing that's different with classic momentum. If people are trading momentum in a single market, again, the classic indicator for them would be percent returns. So as those returns are accelerating and they're trying to capture those returns, they might start to have similar signals to us if that's the same point that creates a breakout. But where they will start to differ is when that trend slows down, they will start to exit the position. And because that percentage change in return will start to decrease, and maybe they will get out. But for us, because we have like a trailing stop, or you're looking for a breakout to the downside at a smaller time frame, or however you manage it, trend followers may still be in. So what might take them 2 or 3 trades to go after, we will have one long running trade, which helps us get more of the outlier meat, so to say, until we're fully stopped out. That's how I really think of this momentum factor thing compared to, say, breakout trend following.
One of the things I've got a concern with the use of the term momentum as a widespread trend following style, simply because the way I understand the market data is that momentum is really what I would regard as serial correlation. It's the dependency of a price point at a previous point in time that actually has a causative effect on a price point at a later period of time. So people will draw the analogy, well, that's like a physics principle of momentum, but it's really serial correlation in the data, which clusters, and you don't get this distribution of serial correlation right throughout the time series. You get it at particular zones in the price series, and at other zones in the price series, you get this phenomenon called noise. And then at another zone in the price series, you get this phenomenon called mean reversion, which is another form of serial correlation, but it's actually in the opposite arrangement to a divergent basis of serial correlation. So I think when you actually get down to the fine detail, terms like momentum, terms like premium, terms like factors, really they're so generic in nature, it has no meaning to me. And I like to think of things more by analogy, looking at other physical systems where I can actually see the mechanics of that system in action. And whether it's a price series or whether it's a natural environment or whether it's all these different types of complex adaptive systems, the mechanics of those systems are very similar, but what differs, of course, is the agents and the physical principles that occur to create those mechanics. So I think you've got to focus on the mechanics, which we do when we say we refer to price action. But I think that price action itself, if you're just relying on price action as a definitive measure, you're missing out on the point of what is important in that price action, and that's that serial correlation in that data, which I think you can only really extract through quantitative methods. So that's where quants do have their value, a particular style of quant who is able to extract that information or the signal from the noise of that data. And that's where I think quants can actually come to facilitate an understanding of what trend following is, that sort of gets to a fairly more deeper level than what a traditional mind might view what trend following is.
It's so great. I mean, I love that, and it's definitely made me understand it a lot better. And I just wonder, of all the years of going to Wall Street and having these meetings, and from people who probably went to bigger schools than I did, and them thinking that trend following was so simple and that they understood it. I'm just thinking, no, I didn't fully understand some of these ideas, and I don't think you have to, but it is really fun to hear, especially about this data and having the serial correlation of the data. I mean, I just never really thought about that so much. I really love that idea. I know I used to be highly offended when at some point, probably with AQR and Cliff Asness, trying to make the case that trend following was cross-sectional momentum. That's what momentum was. Momentum is cross-sectional momentum, which is this, I think Derek was saying, you buy the top 10% stocks, you go long those, you go short the bottom 10%. And then I was like, no, that's not what we do. And then I guess at some point when there's been these crashes in the stock market, the stocks that they're long go down more than the stocks that they're short. So then they had to add this new feature, which is, well, we won't go long any stocks unless they're in an uptrend in and of themselves, and we won't go short unless they're in a downtrend. So the overlay to cross-sectional had to be time series in order to get it to work pretty well. I think that's kind of funny. I've never done a back test on cross-sectional, but it kind of rubs me the wrong way. I don't think that it's healthy to have signals in one market be dependent upon other markets.
That
It's
cross-sectional
badly.
momentum, Jerry, we've got an example of that, which is the S&P 500. That is actually a cross-sectional momentum strategy by virtue of the fact it's using the top 500 cap-weighted stocks. A stock will drop out of the index and a new stock will come in. That is actually a weak form of cross-sectional momentum, and we know how weak that is in dealing with tail risk events. So cross-sectional momentum really has its weakness, I feel, and it's only a strong consideration during a bull market. And who knows how long that's going to last, and that brings in timing consideration. So I think a more pure form is this time series momentum, which is what we're achieving with our trend following. I think that's the only way to deal with this concept that a lot of people refer to as momentum.
Yeah, I think the thing is, momentum is a concept. Derek talked about the Fama French famous paper. The way I read it is, okay, there are some factors that explain or that could explain why returns happen. Let's try to understand what these factors are. So we talk to a lot of traders and understand what they are doing, and we can capture that some of them are exploiting something called value, others are exploiting something called momentum, others are exploiting something called size. Fine. Right. How do we measure this? How can we put this on a scientific term, on scientific terms, and understand if these so-called factors are exploitable or not? All right, let's build a couple of indices and see if these indices have some relationship to the stocks returns themselves. And fine, then they find this relationship, and then they publish their paper and get a lot of attention, and it's pretty informative. Fine, but it's a completely different step to take the results of this paper and turn them into trading execution. And that's what the people that say that they exploit momentum are doing. They are building these baskets of who performed better and who performed worse, and buy the better and sell the worse, and that's what they call momentum. But it's pretty hard because the skewness is completely different from what we trend followers do. Perhaps we are exploiting momentum too, but it's in a completely different way.
And Bruno, I have to say that I think the same for the S&P, because it's one thing to see the index going back decades and decades, and another very different thing must have been to trade it or to buy it, just doing a buy and hold, because it's a backdated index, and also it must have been very very expensive to make that basket of stocks in the 60s or in the 50s, and thus I think that also when people talks about the equity risk premium in the US, they are also interpolating something that it looks good on paper, but it wasn't that good in the past. Today, you have a lot of instruments that really go bit by bit to the index, but I think that it was very, very different in the past, and it's similar to the idea to coming from the paper to the execution.
I'm gonna defend factors and risk premia a bit because I do think it's a great framework. How to understand what we believe has some explanatory power that may be causing the effects that we're taking advantage of. Because, okay, we know that we can backtest these strategies and they become profitable. But not being able to disentangle what that is or what potential effects there are um, kind of leaves you with a question. And I think if you don't have a mental framework, I personally do use the factor and risk premium framework for myself to understand where trend following returns are coming from, or you want to understand what the competition is doing. It gives you a mental framework to understand what, say, a mean reversion trader is doing, or a swap trader, or an options trader, or something like that, what they're trying to exploit. Yes, I do think that there is a big leap from an academic paper to practical alpha. And that's what a lot of people are very good at and do in their day to day. And that's what we all try to do, is to learn from the research that's out there. I think that one of the interesting things I found, not just the behavioral finance answer for trend following, we say, okay, humans keep making the same mistakes over and over again, but in futures markets and specifically commodity markets, we know that there are other types of participants, and those participants, for example, hedgers and commercials, do not have necessarily an economic interest in the futures price. So they're willing to, they need the liquidity. We can provide that liquidity, and they're all going to be pushing in the same direction. So that does have some explanatory power that can be used to regress against those positions in the commitments of traders reports, and can explain some part of why commodities do seem to trend more than other markets.
Look, at the only reason I'd say there is a necessity to understand these risk premia and factors and what mean reversion is, etc., is to specifically exclude that domain from the domain that we operate in. So when we look at our trade distribution of returns, we're dealing with 5% of those returns, which actually give us our edge. We're operating out in the outlier zone, in the non-linear zone, that is a zone that economists don't understand. It's a zone that Mandelbrot understands. It's a zone that Taleb, understands. It's certainly not the zone where you can apply any predictive modelling into that zone. So, by understanding what risk premia is and mean reversion and these things, it's more useful to actually understand what they are, because it defines a predictive domain in the market data, or the normal regime, which you specifically want to avoid with your trend following models. So that allows you to then say, well, here is the Gaussian envelope within which the predictive operators that use risk premia, etc., extract their alpha from the peak of the distribution of returns. Now, if I can define that normal distribution, I can specifically exclude that zone with my filters I applied to my trend following models. So therefore, I'm only operating in this exotic region that exists outside that zone of predictability where their predictive models break down. So that's where I'm getting our edge. Our edge is from the fact that we are getting the edge arising from these failed predictions that come into our turf, if you know what I mean.
Oh, I do agree that we do take advantage of people who are getting hit with margin calls. You could think of gamma barriers for people who are hedging in options, like GME style things. There are other hedgers out there, commercials in most markets, or even in FX, selling large swaptions and things, where they will be triggered for large levels. And if they're a big institution, they can defend those levels. And if those are breached, that will continue. But I disagree that we are not predicting. As people who have a statistical edge in the market, we are in fact taking a forecast that us taking this position in our system will have overall our full distribution a positive expected value. And we know it's a distribution because we are not saying that we know the full outcome of this particular trade, but we know if we take over the long term these trades, we will have ones that go in our direction for a bigger magnitude and longer duration than the ones that are our losers. And so that, in my mind, is our prediction.
But
I
Derek,
think
don't
I'm.
you think that the prediction is that people will not change, that market participants will be behaving the same forever? That's the main prediction of trend following.
I think we can call it maybe prediction, maybe something else, but in fact, it's a philosophical aspect and very important. What is the main, what is the structure, what the base of what we are doing? And I think that idea of trend following, it's not any sort of prediction as we know it. So maybe yes, it have some things that looks like elements of prediction, maybe so, but in general, we deal with unknown future, with uncertainty, and we deal good with this, following trend following rules.
I want to come back on what Oleg and Andreas said, so I'll do Oleg first, just because it's fresher in my mind. I disagree with that because we are predicting which side of that distribution you're on. If you reverse your trend following strategy, you will not have a profitable strategy, right? So we know that by taking this, we have some slight higher percentage to get outliers than not getting outliers. So we have changed our target distribution. We've changed our domain that we are acting in, which is kind of what Richard was saying. But to Andreas's point, I think that's more of the behavioral finance explanation. Humans will keep doing what they're doing. Even algorithms and HFTs are programmed by humans, so there's some kind of underlying human bias that people are going to deal with. I also think that risk management and investment committees are run by humans, so there's always going to be some kind of margin call at some point, which will push markets in that same direction, but that's not necessarily provable. So for me, I do believe that all of these things are mixed together. It's a very confounded variable. Part of it will be the human behavior, which we all try to manage through our psychology, and part of it might be these hedgers and commercials do not have economic value, so we provide some liquidity, and some of it might be that we are able to alter our returns distribution such that we are slightly predicting better outcomes for our trades than just taking random entries.
The only problem I have with the notion of predicting is I'd almost give you the ability to say we project as opposed to predict. But if I have a trade frequency or a win rate of 30%, that to me is certainly not a predictive sort of win rate. It's a recognition that the majority of your trades are going to be losses. So the only form of prediction I believe we're doing is up to the point of entry. We're using current price as our signal for the direction we take. But I wouldn't call it prediction. It's more a reaction to price as opposed to a prognostication, or if price is overvalued or undervalued. And that's predictive because it's therefore changing the direction of what current price is doing. It's a predictive forecast of where price is going to land into the future. And we don't have any form of expectation, and we can't actually measure any expectation with our models. To try and measure expectation with nonlinearity is an impossibility. So, and that comes down to we can't use the Sharpe ratio. There are so many things we can't do in traditional economics, which is sort of embedded into the entire financial system, in that you use these metrics because it's assigning certainty in an environment that we actually have no certainty regarding the domain we operate in. It's an uncertain domain.
No, I still disagree. I'm sorry, Richard. We are predicting that with our systems, we have a higher chance of getting outliers. The win weight percentage is irrelevant. What is relevant and what you are predicting is a positive expected value. Your win percentage times your average winner, minus your losing percentage minus your average loser. That is something we are augmenting compared to just taking random entries and exits.
We can beg
And
to differ.
so, I mean, I think that maybe that's our philosophical difference on.
I think that our expectations are not so big here. We have only expectation that in 3, 4, 5, 6 years we will win. We will be in a profit. And as I remember, Neil said a good phrase that when we are talking about weather forecasts, we are talking about nearest future, and when we are talking about if we ask a scientist who forecast weather, what weather will be in 5 years, he will say that I don't know, I'm sorry. And if we are talking about the market, about trend following methodologies, if you ask a transform trader what will be in a 1 month, what his performance will be in 1 month or 2 months or a year, he will, with a high probability, say that he doesn't know. But in 6, 7, 10 years, transform traders with good rules knows that he will win and he will have a good performance. So there is a not big role of prediction. There is a role maybe of prediction that our rules are really good. Maybe such element of prediction, but I don't see here the predictions elements as the main elements of trend following.
I think this is more as to how you look at things. I mean, on a trade-to-day trade basis, you don't know what's going to happen, right? And one of the principles for trend following is that you're more reacting rather than assume that something's going to happen. So let's say price goes up, okay, let me just put it in. I don't know if it's going to go down, but I'm just going to put it in. But I guess on the system, on an overall basis, you obviously know, or not know, but you have an estimation of what your edge might be. That's why you're employing that system. But I think it's I'm more on the side of that we're not predicting, because prediction would imply that you kind of have this estimation where it is. But I think it also depends on how you look at it. In the end, yeah.
Such as, mammals, did they predict that they would be the occupiers of the world after the dinosaurs were killed off? No, they just did what mammals do and applied their rules and lived as mammals. And suddenly, this out of field, left field event wiped out the dinosaurs and created this opportunity for the mammals. That's how I view outliers. They're non predictable. So, any form of predicting is impossible within our domain. We're relying on these events to occur simply because they've occurred in the past. It's not prediction, it's just a recognition that complex adaptive systems have these outlier events, and they're more frequent than what a Gaussian distribution would imply.
Derek, I think it's almost a difference of the language we speak, actually. Um, we understand prediction in a different way. Hearing from you guys, I
Yeah,
come to this conclusion.
I think so.
I think from a to use statistic jargon, I think that we Oleg, Richard, Jerry most of the time talk about prediction. They are referring to point estimates. And when you, Derek, talk about prediction, you're talking about something more ample, I should say. When we have some understanding about general statistics of what we expect from our systems, then that's what Derek calls prediction. Am I right?
Yeah,
No.
it's part of that. I'm predicting that one thing will come from a different distribution. I'm not predicting it's going to be at 100 tomorrow and 110 the next day. I'm just saying there's a higher probability that it'll come from one. You're picking from one bucket, the non-normal bucket, then you're picking from the normal bucket, and that doing your trade at that time, you have a higher chance of getting something from the non-normal bucket than you have from the normal bucket, if that makes sense.
Hi everyone. I just wanted to add something. So I agree. It's sometimes it's very confusing between time series momentum and cross-sectional momentum. So usually, if you look at the return drivers for time series, momentum is just a classic autocorrelation. Right? It's positive autocorrelation for each of the assets in your universe, for each instrument in the universe. Right? You not mix it. Time series, so cross-sectional momentum, as the way it was originated more by Carhart, I think, and Asnes in a classical way. So you say you in a statistical way you assume there is a factor which has a positive autocorrelation, right? And there are stocks, universe of your stocks or instruments. They have a loading to these factors. So like say most recently you have say momentum factor which has itself, you expect it to have positive returns, and then you estimate say what are factors that are exposed to this. So this is kind of statistical way. Of course, people do it other way around. They just take sample of stocks, do it on a cross-sectional basis. You must do it on I mean usually for isolation of beta you do it sort of beta neutral, so long the top quantile, short bottom quantile, but underlying model is the same. It's more like you try and really separate only one factor that is momentum factor. You historically you assume that it has a positive drift or positive autocorrelation that you must invest. And here is where these kind of details may be different, right? And what you call statistical, say, estimation, momentum usually is say, it looks simpler, but then underlying it's more complicated because you really want to isolate impact of factors. I did try like say a classic. I did. Someone is talking. So I did try like a classical say stock momentum to apply it to futures, right? So cross-sectional momentum, it doesn't work, and for reasons like I think within the asset class universe, right? Instruments are correlated in futures, maybe a part of commodities, but there is not such an effect. It works like say you have say positive expected sharp, but performance wise, say diversification wise is not very strong, right? So why? And the reason also is simple. It's just in some sense time series trend following picks up all the factors that maybe under like can be many factors that drive say particular instrument returns. It can be momentum, quality, carry, value. In the end, if all of them aligns, you will pick it up with time series momentum. So that's all. That's my thoughts. But it's very interesting, and it's always it occurs very frequently. Distinction between time series momentum, what CTAs do, and cross-sectional momentum, which is more specific for stocks.
One thing about both classes that for me is interesting is that trend following, it kind of has small losses and big gains, and sometimes the cross-sectional momentum is the opposite. And although both are based on having autocorrelation and a big movement of the underlying, I remember, for example, how well momentum worked until 2007 for banks, and then it had a big accident on that specific asset class. So although they sound similar, and they are similar in many ways, for me, it's interesting how they are kind of prone to accidents in very different ways. And I agree about what you said, Derek, that using factors to think and to have a good thinking framework is a very useful tool.
Thanks for that, Andre. Look, just for everyone, I have been recording this session, so it's been a very long one, about 2 hours, 18 minutes, and I might split it into two, but then give it to Jerry to distribute through the Twitter feed. But look, I'm not sure about everyone else, but I've got to sort of go now. So if someone wants to keep on going, please just carry on. But thanks, everyone, for your time. Okay, bye.
Thanks here
Thank you.
very much, Richard. Yeah, it was very good, interesting discussion.
Yeah, thanks, Richard.
Thanks everyone. Bye bye.
Thank you.